Joining us now is Michael Zezas. He's the global head of fixed income research at Morgan Stanley. Michael, it's great to have you here. Welcome.
Hey, Kelly. Thanks for having me.
So we can't help but draw, sometimes Occam's razor. They're passing the budget bill, the 10 years at 4.5%, the 30 years at nearly 5% again. Is this because of brightening economic prospects or because of worsening budget ones?
Well, listen, I think when it comes to this bill, it's a bit of a Rorschach test. I think there's something for the bond bulls and for the bond bears to see. So you have a bill that, by the way, is not finished, obviously, and the Senate's already said they're going to write a version of this as well. But we think it all tracks to an extension of the TCJA, some more cuts on top of that, some offsetting spending cuts. And there's already escalators inside of the budget that would have pushed the deficit higher next year anyway. It all tracks to about 7% of GDP. So if you were a bond bear and you look at that, you say, well, the deficit really hasn't come down in any meaningful way. I thought it would. And so that might be a feather in your cap. If you're a bull, you say, well, this is way better than some of the worst case expectations we had there. Ultimately, we think that really it's kind of the growth and inflation dynamic that's going to govern where bond yields go over the next 12 months. And here, we're not terribly concerned about a big move higher from here. And so we think there's plenty of constructive bond investments to make, even if the deficit's working against that somewhat.
So you think it's economic fundamentals really that are really driving things? When we see 4.5% and 5%, this should tell us basically it's just a brightening outlook, or maybe that there's a little bit more inflation than previously expected?
Yeah, well, I think it's a little both, right? So we had tariff de-escalation on Monday, and that took the kind of effective average tariff rate back down to levels we didn't expect you would see until the end of the year. We thought some of this de-escalation with China was going to take more time to play out. And all else equal, what our economists would say is the less tariffs you have relative to what you had, it pushes real growth higher, it pushes the inflation expectations back down. Now, we still expect quite slow growth for this year and next year and higher inflation than you otherwise would have, but relative to where we were last week, it's a better outlook.
Right, but that's why it's so interesting, because I'm just doing the math and saying if bond yields are higher than they were last week, we have better growth to factor into that, less inflation between the CPI and these outlooks you're now referencing. So they should kind of net out on some level. The only new information, although maybe it's not new information, is the way this bill is shaping up.
Yeah, I think that's fair. I mean, listen, there's a couple elements here. So if the bill itself that we think we're looking at right now, because of the SALT deduction debate that still has to happen, the Medicaid cuts debate that still has to happen, I think these numbers are very, very tentative. And most investors we talk to aren't taking a substantial signal from them right now. But if you look at kind of the end game and the contours that we're talking about, we think it tracks towards something like 7% of GDP, a little bit higher than last year. So maybe, about $300 billion higher on a year-over-year basis. Some of that has to be baked into term premium, but I wouldn't read too much into kind of one day's moves, because over the course of realizing that deficit increase over the next 12 months plus, there's still this growth downdraft that we have to experience that we think will push in the other direction.
Yeah, I don't know if we were showing the chart, the deficit as a percent of GDP, because I do think it's important to put these numbers into context. And lately, the chart goes back a few years, so it looks like 7% isn't so bad. But if you extended that out 60 years, 7% is the kind of deficit you'd run in a financial emergency or in a war, And we're now talking about a 7% deficit for a normal economy.
Yeah, so on a one-year basis, if we get to the result we're talking about, you haven't really done anything to change the fiscal trajectory. So if you're thinking long-term and that's causing you to be bearish as a bond investor, this is not going to change your view on how that plays out. But again, where someone who's more of a bond bull might look at this and say, well, actually, because we're not getting the sort of the CBOs, some of the CBO numbers that have been thrown around, an extra 4.5–5 trillion plus over 10 years, then that's potentially a good thing. So we're not addressing the deficit trajectory problem. We're probably not making it any worse than it otherwise would have been. And so then we're kind of reliant on policy 2+ years out when there's a new Congress, there's a different president to make those choices. Effectively, we're kind of deferring the problem of fiscal sustainability amidst this policy.